Hey everyone, welcome back to the Capital Mindset Show. Today we're going to be covering another stock, and this one actually was the runner-up from last week's vote, so we're covering it here today, and that is DraftKings. So if you guys want to participate in the votes, there's a free Discord community down in the description below for you to join. You just have to answer 3 questions as a vetting process, so we don't allow spam bots in. And on that note, we're going to go over to the stock that we're going to talk about, which again is DraftKings. And in that, we're going to first talk about the price action, see what's been going on. And this actually is a fairly interesting company. The quick rundown is sports gambling, sports betting. So sports betting is being widely adopted in the United States. It's already kind of adopted in Europe. It's already Canada, I think so as well. And so with that being said, there's a lot of supposed tailwinds for this company. The market cap is sitting at $5.76 billion here today. If you look at the 5-year, you can see kind of the story play out. It went through this massive moment. This was the SPAC days, and it just rose all the way up about 573%, all the way down to 80%. Okay, so there is a lot of commentary, and actually, if you actually look up DraftKings stock here on YouTube, you can see all the different videos that people make on DraftKings. Well, actually, now that's no longer talking about DraftKings. That's just, the algorithm saying, watch this video on DraftKings. So you can watch a couple of them and get the idea for it. But basically right here, it's sitting at $14.10. We're going to talk a little bit about another company called Golden Nugget. So Golden Nugget, blah, 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 is very important for you to kind of get familiar with if you're thinking about the stock, because they acquired Golden Nugget. And actually, there's a good case study to learn from this. So also, I want to shout out this creator, because this creator did provide a lot of value. So right here, this creator right here. So if you watch this video, the DraftKings Truth, posted on December 8th, 2021. This is important because this is not from the stock's perspective. This is from the user's perspective. So a lot of the issues brought up by this person, I've actually confirmed and actually looked to see there is a lot on this, okay, a lot on this. And actually, when it comes to that, it seems like they are burning a lot of bridges when it comes to consumers. Not everyone, and of course, there's a lot of anecdotal evidence out there, but the data does indicate a little bit that there might be a little bit of that going on, and that is negative from the investment standpoint, because we have to be careful how the company is carrying itself. At the end of the day, a lot of people think, mean, evil corporation. No, you have to be nice to both your customers and your employees too. You want to be a good place to work, and you want to be a place where people want to do business with you. Okay, so both of those are the recipe for success. If DraftKings is not doing that, then unfortunately, long-term success is going to be far more difficult. Okay, of course, there might be internal reasons as to why they're doing that, but we'll actually get to some of the math regarding that. But the company, again, you have to familiarize yourself with is Golden Nugget. So they are, in essence, tied to the performance of DraftKings because of the acquisition that DraftKings actually announced on a Golden Nugget, which we will go over around here. So you see this massive run-up was because of that acquisition. Now, it was for a 50% premium to the market cap, and it was a trade deal using shares. So the actual deal itself, again, was a promise of shares, and I think this was the day around here. I think it was like here-ish. Yeah, so that's about where it went. So in essence, what you're going to do, or what you're going to get if you own shares of Golden Nugget, is you're going to get shares of DraftKings. Now, there might be a small so to speak, there could be a small arbitrage play, but I'm not really going to look into that per se. I'm just going to look at DraftKings, and then I'm going to understand what the management was seeing when they acquired Golden Nugget. Off the bat, or off the beaten path, I think that it's more likely that, not more likely, it's almost certain that they looked at this like a quick grab of customers. So Golden Nugget has a bunch of customers, DraftKings comes in and buys the company, and they get all those customers. So DraftKings looks like they want to benefit and kind of grow in that capacity. So DraftKings has been growing very aggressively, by the way, extremely aggressively. In fact, if I actually cite the actual growth rates that they've been growing at, they grew about 110% the year before, and about 60% is the forward projected growth of DraftKings in terms of sales. Okay, but sales isn't everything. And actually, when we get to the actual evaluation process, which we're basically there, just one more thing to cover, we're gonna actually talk about that even more. So looking here, we have Kathy Wood's ARK Invest buys slide again, DraftKings and Roblox. Okay, the reason why I'm pointing this out is this is another Cathie Wood stock apparently. So I don't know how up to date this is, but if we go on ARK's stock, just go check it out if it's still there. If it's not, it's not. But regardless, okay, so we're done with this. We're going to go over to the evaluation model, and we'll talk a little bit about that. So when we're over here, let's actually go here. Okay, so we're going to plug in, and the ticker symbol is DKNG. I always think there's an F in there, but it's DKNG. Okay, so as it's pulled up, I'm going to actually take us over to this thing, which is our play sheet, where I can actually showcase some things for you guys here. And I'm going to zoom in a little bit more so we can take not so much empty screen. Okay, I'm going to zoom in actually even more because I can see how it's recording. Just so everyone understands, sometimes when it's not because I have like eagle eyes or anything like that. It's recording. I can see how it records and how I see it. How I see it is pretty zoomed in right now. How you guys see it is kind of zoomed out, actually, if you ask me. But let's actually can I increase it even further? Yes, I can. Let's try it out. No, 200%. All right, that's it. 200%. That's all I get. All right. So anyways, let's actually then center it. I'll just drag all this and just center it over here. Yeah, that's fine. All right. So I'll explain what all these numbers mean actually when they're over there. So JNoggy, or not JNoggy, sorry, GNog is a YouTuber. Go check him out. But GNog is a golden nugget. Okay, so they're another betting play, you could say. They were acquired for an evaluation at the time of $1.56 billion when DraftKings was valued at $20.6 billion. You can see that the deal implies a 7.57% shares float of that deal, okay, and paying a 53% premium at the time the deal was valued at that of over JNog's share price, okay? So that's what the premium means. There's no premium for DraftKings. That's why there's an NA, okay? Adjusted EBITDA for GNog here today, or not here today, up to date in the most recent quarter was about negative 6.9 million, sales of 31 million. It implies an EBITDA margin of negative 21.85. Okay, why am I talking about EBITDA? Because when we take a look at a company, when we acquire an entire company, and this is just a quick analysis, but when we acquire an entire company, we actually will think about EBITDA, because when we combine the two entities, then the two entities will become one entity, and in that instance we will handle the taxes, depreciation, interest, and all that jazz. And we have to look at the enterprise value. Okay, so when looking at the enterprise value, we have to consider in totality what it is that we're looking at. So with regards to GNog, right, we're taking a look at the sales, okay, the sales total, the EBITDA. By the way, the EBITDA is an adjusted EBITDA because they had some one-time things that were kind of boosting up the EBITDA. So the company actually provided adjusted EBITDA margins, and then so we kind of just calculated from there. DraftKings, same thing. Why does DraftKings have negative over 110%? We'll get to that. I know you're thinking, like, why is that there? We'll get to that. Then from there, we understand that operationally, neither of these companies are actually profitable. So then, now we're going to the last resort, which is the price to sales ratio. Oh no. So price to sales ratio, but we kind of both see that they're kind of trading at the same. All right. So basically DraftKings was like, you're undervalued. We'll offer you to buy you out at the same price of sales as us. Okay. So think about it like that. All right. So on that note, is that a good thing? And that, by the way, that was at the time. On that note, is that a good thing? I don't know. We'll find out when we get to the later parts of the evaluation, but we're just kind of walking backwards and kind of thinking about the management's process. And some of these numbers are kind of rounded or estimated. So keep that in mind. It's not precise, but it's good enough. It's good enough for us to get an idea. And so why are we looking again at EBITDA? Let me just reiterate that one more time, because when we look at EBITDA, that EBITDA is something I'd look at if we were acquiring a whole company. So at work, when we look at private deals, and we're looking to acquire entirety of a business, what we'll do is we'll actually look at the EBITDA, right? In essence, the EBITDA of the business. And we'll assume that, we're going to take on, the liabilities, and they're going to take on the cash. So then that comes into the enterprise value of the actual deal. And then we look at the operational incomes and how that would tuck into the enterprise as a whole. So EBITDA is what we would use. In this case, DraftKings would probably look at GNog's EBITDA. Their finance team would look at that. So on that note, I'd say that there's not much to say about that except for DraftKings being hyperly aggressive in terms of how they acquire customers. You can see that again in the EBITDA margin. The EBITDA margin tells you that because when it's negative 110%, that is where you can actually see that acquisition cost for the customer. They're spending more in the above line items than they're earning. So it's resulting in a 10% increase and 10% above value in terms of a loss for acquiring customers. Okay. And again, DraftKings is known to be quite aggressive. You've probably seen the deals like they'll give you money if you start gambling with them because that's the game that they're in. They're in the addiction business, and quite literally so, where they try to get you into these habits of gambling, and bada bing, bada boom, you're probably going to be a loyal customer. Now, keep in mind that video I showed you does provide a decent amount of insight into the business practices by DraftKings that are quite questionable to say the least, but that's all I'll say. I won't say it personally just in case, but you can watch that individual and he can kind of walk you through that. All right, so taking a look at the summer report, we kind of dragged in DraftKings, and we are not going to stay this zoomed in. We're not going to stay that zoomed out. We're going to do the sweet spot, which is 125%. All right, so we are going to do the unprofitable analysis. Yes, we are going to assume that the profits achieved are around 10-ish%. 10-ish%. We're going to give them some time because it can improve later, but we're going to give it some time, and we're going to say that they can achieve this in about 5 years. Okay, so if they can achieve this in about 5 years, that's there. Now, the dilution rate has been rather drastic. We have to consider the acquisition that they did. All right, so let's be fair with them. But however, this is a bit of a concern because I do think that this isn't going to stop, especially with the current temperament around the acquisitions. Taking a look at the Altman Z-score, it does imply that it is ambiguous whether or not they will go bankrupt. Also, the other metric is also saying it doesn't know. So usually those always coincide. When they don't, that's a concern. But yes, they're not capable of doing any buybacks. They're probably going to do some share dilution. And with that being said, the prices come down so drastically. You can see that these prices above that were quite ridiculous. They were quite concerning. Okay, if you want any sort of margin of safety, which I don't understand why you wouldn't want one, you can see that even at a 30% growth estimation, you're just not there yet. You have to drop it by another 50%. Okay, so that's a little bit of a concern. That's actually below the price that they were SPAC'd out at. So consider this: the SPAC probably overpaid. The SPAC probably got it at a hype moment, so probably the value is probably around $7-ish, which would still be in the billions of dollars. By the way, just so everyone understands that, it would still be about like $2-ish billion. It would almost be $3 billion if we're trying to be precise. But yes, regardless. So I think in 5 years, I'm being quite generous that they achieve profitability. They might not even achieve it in 5 years. And 10%, I'm trying to be a little conservative there, to be honest, because some of you might say, well, this is a platform, so they're going to make a ton of money relative to the sales. Sure, whatever. But yeah, that's basically it. And this implies that this negative implies that these growth rates do not actually provide enough growth in the nearer term for it to actually print out a positive value over the next 10 years. So what we have to do, we consider that, okay, consider those numbers, that those are really bad cases that the company's worth nothing in the next 10 years, or not worth nothing. And that's not worth the investment whatsoever, that there is no price that you should buy within the next 10 years. And of course, that's with a decent margin of safety. Okay, so if we, for example, start to assume that, that 15% is probably like 10% is the low end, or sorry, not 12%. I meant to say 12%. My brain didn't work. Even 12% doesn't work. That's interesting. So let's see, even 13%. 13% doesn't work. 14% does work. So 14% just barely works. And that 1% is a big deal because you can see the jump there. All right. So kind of my rough thoughts going forward is DraftKings is, obviously de-risked. Because the price has come down a lot. I'm not stating anything intelligent there, but I think that, and by the way, the price target by analysts is $25.97, implying an 84.18% upside. They're infallible, therefore forget everything I said. Okay. Anyways, and then the analysts also have a buy rating, so just listen to them, right? That's what we do. No, I'm just kidding. So let's actually take a look at the ratios and then kind of give my closing thoughts. So ratios look pretty good in the liquidity ratios. They look pretty good in the solvency ratios. Nothing crazy there. It's getting worse, but that's fine. DuPont's analysis is getting drastically worse. That's, oh, you know what? That's probably because of cost of acquisitions. Operating profits, yeah, well, that's getting really bad because of acquisitions. Earnings quality is absolutely abysmal. Oh my gosh. All right. So earnings quality has never been good, apparently, except for 2017. So on that note, you know, kind of giving my summary thoughts on DraftKings, I don't really particularly care for this business. If anything, this would be a speculation play at best. But, you know, not even that good of a speculation play, if you ask me. There are probably better risk reward plays with higher potentials. This is a very competitive industry. You also have FanDuel. I mean, if you have this situation where customers are not liking it, and there's like a saying apparently that, you know, it's easy to put your money in, but you have to do a lawsuit to get your money out. You know, a bit of a concern there in that regard, if that is actually what customers are saying. Or people in general in the gambling space are saying about these types of companies. Okay, so when you have a lot of competition, it's concerning. Really, who has the power is the NFL, the people who actually control the sport, because they give you the sport book. It's their brand at the end of the day, and so they really do have a stranglehold on this. Of course, again, you have the traditional casinos that are coming in and making their own products. Of course, DraftKings is like the biggest known name, I think, and they're spending a lot on that branding, a lot on that acquisition. Whether or not that pays off is yet to be seen in the long term. That is the risk that you are taking when you are buying the stock. Please consider all of that. And on that note, those are my thoughts. This is the capital mindset thought on this stock. And I hope you guys enjoyed the video. If you did, feel free to leave a like, subscribe if you're not, and you can come back and probably cover the stock that you're looking at too. On that note, guys, thank you guys so much for watching. I'll see you on the next one. Bye.